Let's now take a closer look at the markets with Vadim Zlotnikov. He is chief market strategist at AlianceBernstein, where his research helps manage $450 billion in assets. And Vadim, we haven't talked to you in a long time, so it's really a pleasure to have you in to talk about what's going on today, even if it's not the most fortunate of days for folks who are long the market. I want to start with Europe and talk about what's happening there and the perception that it will have this ripple effect.
Right.
Do you think that's the case?
I think, look, Europe is wrestling very much with the same problem U.S. is. On one hand, you have to address the long-term problems of debt. On the other hand, you want to maintain near-term confidence so the business cycle has a chance of recovering. And some of the events of today and some of the fears that have come to pressure the markets today suggesting that you may need a resolution sooner than you would have ideally liked. So whether the Greece need to restructure the debt today, whether the downgrade of Italy happens sooner than would have been expected is what's weighing in on the markets.
So when all of that does happen, I mean, sort of walk us through it. I mean, if you do see a default situation and the banks in Europe that hold that debt are adversely affected, I mean, do we then see the effect here in the U.S. as well?
It depends how far the contagion spreads. I think a lot of the restructuring for Greece has been priced in. And I don't think that alone would compromise the liquidity situation for German banks or French banks. Even if we have problems in Portugal, I think that problem could remain contained. To the extent we start to see problems develop beyond those two countries, I do think there is a greater chance for contagion, in which case the fear in the U.S. is justified.
Well, that was going to be my next question. I mean, do you think that this pullback that we're seeing today is commensurate with the risk that is out there? 1% pullback is never commensurate with the risk of contagion because it's very much a tail event. And so you do have a market that's going to be very much driven by data, driven by commentary out of EU. How much capital are they willing to commit? Are they willing to provide liquidity to Spain so that it's able to avoid refinancing risk? If they take the right measures and at the same time provide at least a hint of what they're going to do over the long term to solve the problems, I think we could avert catastrophe. I want to talk about what's going on in the currency markets as a result of all this as well. Sheila Dharmarajan a few moments ago talked about that the dollar is strengthening, and that could potentially be negative for some U.S. corporations, which have benefited so greatly from the weaker dollar. Right. How much of a weight is that going to be on corporate earnings, which have been, as you know, so fabulous thus far? Well,
obviously it depends how much strengthening takes place, but for now I don't think it's a problem. And I don't think one should always be one-dimensional about the movement of a dollar. For the last couple of years, the dollar trade has been very much a risk trade. When the dollar goes up, it generally means there's a lot of risk aversion in the market, and you observe equities go down, you observe commodities go down. I do think going forward, you have to think of dollar both from a perspective of what it means about risk aversion, but more importantly, what does it mean from the U.S. consumer? Because to the extent you do get lower commodity prices, to the extent it does have an effect on oil prices, it could actually be a modest positive because it actually removes some of the inflationary fears in the market, and which allow the Fed to stay to avoid tightening for much longer.
So given all of this that we've been talking about, what do you think is going to happen with stocks here for the next, call it 6-9 months?
I think we're going to have to come to some resolution with Europe sometime soon. We're also, by the third quarter of this year, we'll probably see enough deceleration in the emerging markets that we'll start to talk a lot more about the end of the tightening cycle in the emerging markets. At that point, the direction of the market is going to be determined just by one variable. Have we been able to address, even over long term, some of the concerns about the deficit, which would give a consumer enough confidence to come back into the market? Overall, I do think there's more upside than downside. If we start our clock sometime after the summer, we need to allow some of the changes we're seeing now to play out. But two things to remember. There's a lot of pent-up demand from both corporations and consumers in terms of durable spending, and that's going to be important for the economy. And two, banks have plenty of reserves to lend, so there's a lot of liquidity. What's missing is the confidence.
And where's that going to come from?
And the only way you're going to be able to get that is you're going to need to see resolution of some of the issues we've had, or even just a delay, sufficient delay to allow the economic cycle to continue. And there's a lot of uncertainty of how far China is going to go, how far Brazil is going to go in terms of decelerating its economy. We just need to see what the bottom looks like. That could be enough of a confidence.
What to do with all of that money? I mentioned before the break that we want to get into some of your sector picks. And it's sort of a mix of cyclicals and defensive, but let's consumer cyclicals you like, which
which I realize
is a little tricky in this environment.
Absolutely. It's a very controversial bet. If you look at history, this is probably not the right time for only consumer cyclicals, so why do we bother? One of the reasons is a lot of the recovery in consumer cyclicals has been delayed. The household formation has been lagging. The employment growth has been lagging. So there is a fair bit of pent-up demand. The age of durable goods like refrigerators and cars is very long, so people will need to replace them. So there is a fair bit of pent-up demand out there. So to the extent we see even a modest economic recovery and consumer willingness to spend, I do believe these stocks can still work from here.
Well, even if demand picks back up and sales pick back up, what about the margins? Because as we know, with prices going up, input costs that is going up for a lot of these companies, they're having a lot of trouble passing on those costs to their customers.
Absolutely right. And that's what actually hurt a lot of the margins if we look back over the next 6 months. Now with some of the deceleration in the emerging markets, some of the strengthening of the dollar, you actually could see some of the commodity prices start to weaken a bit and would relieve some of the pressures. At the same time, companies have already passed through some of the price increases and should be able to sustain margins going forward.
Now, one of your other groups that you're looking at, I believe, is healthcare as attractive right now, which is sort of the opposite in some ways of consumer cyclicals. What's your outlook for healthcare? Why is that a group that you're looking at?
The main one is very, very, very low expectations. And if you think about dichotomy, investors believe healthcare earnings will have virtually no growth as a sector for the next 5 years. The biggest concern for the government is that the healthcare spending is growing at 1.5 times GDP. That's a very big disconnect. So the reason for that is investors believe that the margins will collapse. So one way you can invest in healthcare is you make a bet on the volume growth without having to necessarily make a bet on companies where you're seeing a lot of patent expiration, where you see a lot of reimbursement cost pressures. So bet on volume continuing to grow, part of the demographics, and top line continuing to grow, but margins could come under pressure.
Margins could, but won't the stocks then come under the pressure? For
certain segments of the healthcare, such as some of the big pharma names, where you are seeing a lot of drugs come off patents. In medtech, medical technology, you are also seeing some erosion. On the other hand, on the services side, you're certainly not. Some of the diagnostics could continue to do well. So it's a bit of a dichotomy.
Okay. Vadim, thank you again for coming in. It was good to talk to you. Vadim Zlotnikov of AlianceBernstein coming to talk to us about strategy and picks today.